The C Corporation offers some of the most powerful tax benefits in the world, and it is one of the most misunderstood tax vehicles. You can use a C Corporation to shelter income, pay less taxes, and protect your personal assets. And I'm going to show you how to do this in this video. As a tax CPA at mycpacoach.com, I have clients that save more money with a C Corporation than they would with an S Corporation, LLC, partnership, or sole proprietorship. You see, the problem with those entity structures is that you have to pay personal income tax on 100% of your business profits, even if you do not touch those profits. So if you only took out, let's say 20% of your profits from your business as a distribution, it would not matter. You would still pay 100% tax on all of the business income. This takes more money out of your pockets that could have otherwise been put back into your business to grow your wealth, but instead it will just go to Uncle Sam. So that's the first problem. The second problem is that even if you do need to take money out of your business, you may still end up paying more taxes than you would as a C Corporation due to the differences in tax rates. The maximum C Corp tax rate is 21%. And the maximum individual tax rate is 37%. So if your tax bracket is in this gap, there may be opportunities for you to pay less taxes as a C Corporation. But what about double taxation? Well, a lot of people misunderstand that too. For one, you don't pay double taxes when you do not take any distributions or dividends from your C Corp. And two, even if you do, that does not mean you have to take 100% of your business profits as a dividend. You can simply take the exact amount that you need and manage that second tax to be as low as it possibly can be. So I want to give you a proper breakdown of the C Corporation and all of the benefits that it has. And if you stay until the end, I will even give you some scenarios where it has saved my clients boatloads of money in taxes. All right, let's start from the top. What exactly is a C Corporation? Put simply, it is a business structure that separates the owner of the business from the business itself. So think of the business as a separate person. It has its own life, its own social security number, its own assets, and none of that has anything to do with you as the owner since it is separate from you. So if someone sues the C Corporation, they could only go after the C Corp's assets, but not your personal assets. Because of this separation, C Corps provide the maximum amount of liability protection available to its shareholders. This is also why the corporate income tax exists in the first place. Since the C Corporation has a life of its own, it must pay taxes on its own income separately from the taxes of its owners. And a lot of wealthy individuals like using C Corporations because of this. They can essentially have no assets or income tied to their personal names and park all of their wealth in their C Corporations. So when we hear stories about the wealthy paying no taxes, it is usually because they are not paying individual income taxes. And they are not paying individual income tax because they have no income tied to their personal names. I mean, there are literally CEOs of billion-dollar corporations taking a $1 salary from their company. And many others famously just pay 0 to 3% of all of their individual income towards taxes, while everyone else pays up to 37% of their income towards individual taxes. So in short, you can use a C Corporation to take advantage of lower tax rates and shelter your income away from that individual income tax, which can be taxed at a higher rate. So let's look at how corporations are taxed in general, and then we will look at ways to take advantage of this tax structure. All right, so first I want you to take a look at this chart. This is how the corporate tax rate has changed over the last 70 years. As you can see, the corporate tax rate used to be as high as 50%. But it has been steadily decreasing over time, with the most recent cut being in 2017 with the Tax Cuts and Jobs Act. Now, this act reduced the corporate tax rate to a flat 21%. And there is a chance that this can go down even lower, but I will save speculation for another video. Now, when looking at how C corporations are taxed, we have to not only consider the corporate tax rate, but also how you will be taxed as an individual when you are being paid from that C corporation. So here is the general flow. When your C corporation earns income, it pays corporate income tax. That is the first tax. Then if your C corporation pays dividends to its shareholders, then they pay capital gains tax on that amount, which could be taxed as low as 0 to 20% depending on your individual income. For example, if your total income with dividends is less than $47,000 as a single taxpayer or $94,000 as a married taxpayer, then your dividends could be taxed as 0% if they qualify as qualified dividends. So in this case, you would not really pay a double tax at all, even though you did receive dividends. But if you did have income above this threshold, it would likely be taxed at 15% as a qualified dividend. Now remember, as the C Corp, you have full control over the amount of dividends you take, and carefully planning this number could significantly reduce your taxes, and I'm about to show you how. So let's look at a very simple example to start here. So let's say you earned $100 and you are already in the 37% tax bracket. So as an individual, you would pay $37 in individual income tax on that amount as an LLC. Now let's compare this tax to a C corporation. As a C Corp, those $100 would first be taxed at 21%, resulting in a $21 corporate income tax. Now at that point, there is only $79 left that can be taken as a dividend from the business. So if you took the remaining amount as a qualified dividend taxed at 15%, you would pay $11.85 in taxes. So even with distributing all remaining profits, your total tax is about $33 or about 33% instead of the 37% tax you would pay as an individual. In that case, you would pay about 4% less in taxes. And this is actually the worst case here in this example. So let's flip this and say you took no dividends from the business. And in that case, you would have saved $16 or 16% overall in federal taxes. And that will be the best case scenario here. Now let's look at the final, more conservative scenario. So let's say you took half of your remaining $79 in income as a dividend, which would be a $38 dividend. That would only result in about $5.70 in taxes, or an extra 5.7% overall. In that case, your net tax rate is 26.7% instead of 37%, still saving you about 10% in federal income taxes. Now, this is just a simple example. Usually we are dealing with thousands and sometimes hundreds or even millions of dollars in income. So these small differences in tax rates can result in tens of thousands of dollars in tax savings depending on the amount of income you earn. For example, 10% saved on $100,000 in income would be $10,000 in tax savings, or it would be $100,000 in tax savings on $1 million in income, just to add some context here. Now, to add to that, there are even more advanced entity structures that may involve using multiple entities, with one of those entities typically being a C corporation. Some people set up C Corps as management companies, holding companies, and in many other ways to split some of their income into that lower tax rate. Ultimately, everything we have discussed so far is simply trying to accomplish a tactic called tax rate arbitrage, which simply seeks to take advantage of differences in tax rates amongst different classifications. Now, everyone watching this video may not be in the 37% tax bracket, but that does not mean that they could not benefit from these differences in tax rates based on their situation. If you have any income that is being taxed above 21%, then it is possible that a C corporation may save you some money in taxes. Now, with that said, I do have to tell you that the IRS has a rule associated with C corporations with excess earnings left in their business. They know that with the corporate tax rate being lower, people will try to avoid paying dividends to their owners and shareholders to pay less taxes. So they implemented something called the accumulated earnings tax. And you need to know this. Basically, this is a 20% tax penalty on what they deem to be excessive retained earnings. Or in other words, earnings kept in the business beyond the reasonable needs of that business. Now, this tax is very subjective, but it does have teeth. The IRS can challenge the amount of earnings kept in your business and assess a tax penalty. But there are some exceptions to this rule. Now, the most significant exception is that if you have a business purpose for the accumulated earnings left in the business, then those earnings would not be subject to the accumulated earnings tax. So in short, you have to have a plan for the funds that you retain or keep in your C corporation. Maybe you are leaving money in the business to buy things like equipment, inventory, or property in the future. Or maybe you are saving for an acquisition or simply planning to expand your business by hiring more employees or making bigger investments. There are a variety of valid business purposes that may warrant leaving large amounts of capital in your business. Just think about major corporations like Apple, Amazon, Google, and so on. They literally have billions of dollars in accumulated earnings. So it is okay to retain money in your corporation, but you must do so in a manner that makes sense for your business, which is also why it's important to have a tax CPA to advise you on things like this. Now, in addition to taking advantage of differences in tax rates, there are a number of additional tax benefits associated with C corporations. So let's quickly go through this. So here are a few examples. C corporations is the only business entity that can write off charitable contributions. For all other business entities, charitable donations can only be claimed as an itemized deduction on your individual tax return, which most people do not even claim these days because the standard deduction is so high. C corporations are also able to offer something called fringe benefits, which allows them to write off the cost of various benefit plans offered to their employees, which the owner could be as well. There are ways to write off child care expenses, for example, by implementing a dependent care assistance program. And there are ways to write off your health expenses by offering a health reimbursement arrangement plan. And you can also write off 100% of your health insurance, long-term care, or disability insurance premiums if set up correctly under your business. If you want specific guidance on the best entity to use for your unique situation, just book a free consultation with my tax team today at mycpacoach.com. As always, thank you for watching.